You might think you're making all the right moves in your investment journey, but even the savviest among us are prone to hidden mistakes that can quietly erode our wealth over time. These aren't the obvious errors you hear about every day. No, these are the ones that sneak in under the radar and can have a lifelong impact on your financial success. Welcome to Financial Thoughts, where we don't just talk about growing wealth, we inspire the future billionaires of tomorrow. If you're here, it's because you know the value of thinking differently, of challenging the status quo, and of continuously refining your financial strategy. Now I want to hear from you. Which skills are you focusing on mastering in your financial journey? Drop a comment below, let's start a conversation and learn from each other. Let's dive into the common traps that even smart investors fall into, and how you can avoid them to secure your financial legacy. 1. Extrapolation fallacy. When a stock has been on a winning streak, it's easy to fall into the trap of thinking it will keep going up indefinitely. This thought pattern, known as the extrapolation fallacy, can lead to overconfidence and risky investments. The reality is that stock prices fluctuate due to a variety of factors, and past performance isn't always a reliable indicator of future success. Believing that a stock will continue to rise just because it has been can blind you to potential downturns and keep you from making more informed decisions. To avoid this pitfall, it's crucial to stay grounded and assess each investment opportunity based on current data and a well-rounded understanding of market conditions. Instead of assuming that a rising trend will persist, take the time to analyze the factors driving the stock's performance and consider how they might change. Being mindful of the extrapolation fallacy can help you stay realistic about the risks involved and prevent you from chasing gains that may never materialize. 1. Popularity bias. In the world of investing, it's tempting to follow the crowd. When everyone seems to be buying a particular stock, it can create a sense of urgency and fear of missing out. This is where popularity bias comes into play, leading you to believe that a stock must be a good investment simply because it's popular. However, the herd mentality often drives up prices without a solid foundation, and jumping on the bandwagon without doing your own research can result in poor outcomes. To counteract popularity bias, take a step back and critically evaluate the investment on its own merits. Ask yourself if the stock's fundamentals justify its popularity or if it's just riding a wave of hype. Independent research and analysis are your best tools to make informed decisions that align with your financial goals, rather than simply following the crowd. 1. Sunk cost fallacy. The sunk cost fallacy can trap you in a bad investment by making you feel like you've already invested too much to turn back. You might think, I've lost so much money on this stock already, I can't afford to sell now. This mindset keeps you holding on to underperforming assets in the hope that they will somehow recover, even when the chances are slim. The reality is that holding on to a bad investment out of pride or stubbornness only increases your potential losses. Recognizing when it's time to cut your losses is a key part of smart investing. Accepting that you've made a mistake and moving on to better opportunities can be difficult, but it's often the wisest choice. By letting go of the sunk cost fallacy, you free yourself to make decisions based on the current situation rather than past regrets. 1. Hot hand fallacy. After a few successful investments, it's natural to feel confident. The hot hand fallacy occurs when this confidence turns into overconfidence, leading you to believe that your winning streak will continue indefinitely. You might start to think, I've been on a roll, so my next pick will definitely be a winner, and begin making bigger, riskier bets. However, luck plays a significant role in investing, and past success doesn't guarantee future results. To guard against the hot hand fallacy, it's important to maintain a disciplined approach to investing. Keep your risk tolerance in check and continue to base your decisions on thorough analysis rather than a streak of good fortune. By staying grounded and avoiding the temptation to bet big on the next sure thing, you can protect your portfolio from unnecessary risks. 1. Confirmation bias. Confirmation bias is a sneaky trap that can lead you to see only what you want to see in your investments. When you're excited about a stock, it's easy to focus on information that supports your enthusiasm while ignoring or downplaying anything that contradicts it. This selective perception can blind you to potential problems and cause you to overlook critical warning signs. To overcome confirmation bias, it's essential to seek out diverse perspectives and consider opposing viewpoints actively. challenge your assumptions by looking for data and opinions that contradict your initial belief about a stock. This approach can help you make more balanced and informed decisions, reducing the likelihood of costly mistakes. 1. False cause fallacy. The false cause fallacy occurs when you mistakenly assume that one event caused another just because they happened in sequence. For example, if a stock's price rises after a CEO leaves, you might conclude that the CEO was the problem and that the stock will continue to perform well. However, the stock's movement could be due to any number of factors unrelated to the CEO's departure. Avoiding the false cause fallacy requires a deeper analysis of the situation. Instead of jumping to conclusions based on timing alone, take a closer look at the broader context. Consider other factors that might be influencing the stock's performance, and don't rush to attribute causality without sufficient evidence. This cautious approach can help you avoid making investment decisions based on faulty reasoning. 1. Pessimism bias. When markets are in decline, it's easy to let pessimism take over, leading you to think, the market's going down, I need to sell everything. This knee-jerk reaction, known as pessimism bias, can cause you to make rash decisions that hurt your long-term financial health. Selling off your investments in a panic often means locking in losses and missing out on potential recoveries. Instead of succumbing to pessimism, it's important to maintain a level-headed approach during market downturns. Remember that market fluctuations are normal, and selling in a panic can do more harm than good. A better strategy is to reassess your portfolio, make any necessary adjustments, and stay focused on your long-term goals. This mindset can help you navigate challenging market conditions without making decisions you'll later regret. 1. Pattern fallacy. The pattern fallacy is the mistaken belief that just because a stock has been falling, it's bound to go back up soon. This kind of thinking ignores the fact that stock prices don't follow predictable patterns, and that a stock's past performance doesn't guarantee its future direction. Believing in this fallacy can lead you to hold on to or buy into declining stocks with the false hope that they will rebound. To avoid the pattern fallacy, focus on the fundamentals of the stock rather than assuming a rebound is imminent. Analyze the reasons behind the stock's decline and consider whether they are temporary or indicative of deeper issues. Making decisions based on solid research and analysis rather than hoping for a turnaround can help you avoid getting stuck in a losing investment. The strategies we've discussed today aren't just theory. They're powerful tools that you can start applying right now to transform your financial journey. Remember, recognizing these hidden mistakes is the first step toward avoiding them and securing the future you deserve. You've got the knowledge, now it's time to put it into action. If you found these insights valuable, don't stop here. Explore our related content to deepen your understanding and keep refining your approach. And of course, if you haven't already, make sure to subscribe to Financial Thoughts. By subscribing, you'll get access to even more strategies and tips to help you stay ahead of the curve. Let's keep this conversation going. Comment below on the skills you're working to master and join a community of like-minded individuals dedicated to financial excellence. Your journey to becoming a future billionaire starts with one step. Let's take it together.